Welcome to the video. Today we're unpacking how high APR car loans quietly drain thousands of dollars from new buyers, and what you can do starting today to escape. First, we'll frame the problem using a real 14% APR example. Next, we'll break down immediate steps you can take, from refinancing to selling and early payoff strategies. Finally, we'll test your knowledge with quick quizzes and wrap with practical takeaways. Let's get started. Here's the roadmap. First, why APR matters more than the monthly number. Second, how the low payment pitch traps you in long, expensive loans. Third, the immediate fixes: refinancing, selling, or paying down aggressively. Fourth, we'll share simple affordability rules. Finally, we'll summarize key takeaways. APR determines the true cost of borrowing. A high APR dramatically increases the amount you pay over the life of the loan, particularly with longer terms like 72 months. In the example, we'll focus on 14% APR on a $33,000 car over 6 years. The interest alone comes out to roughly $17,000, meaning the total cost is about $50,000. This is why focusing solely on the monthly payment is so dangerous. Now, let's unpack the trap behind those low monthly offers. Dealers often steer buyers to focus on the monthly number. By stretching loans to 72 or even 84 months, the payment seems manageable, but the interest becomes enormous. In our example, you'd pay about $17,000 in interest on a $33,000 vehicle at 14% APR over 72 months. That totals around $50,000 for something that is losing value the entire time. A simple guideline is to keep your car payment to 10 to 20% of your take-home pay, and ideally much less. Next, let's visualize your options to escape this trap. Begin by reviewing your loan terms and budget. If your payment is more than 20% of your take-home pay, selling the car is usually the most responsible move. If it's below that threshold, check whether you can refinance to a significantly lower rate through a credit union. If you can't refinance, determine if you can make consistent extra principal payments. If you can't do that either, reduce expenses or increase income, then try again. The goal is to move into a debt-free driving plan for the long term. Now, let's turn this flow into concrete steps with a timeline you can follow starting today. First, aggressive refinancing. Begin with local credit unions. They often beat dealer and traditional lender rates. A strong cosigner can help you qualify. Second, if your payment exceeds 10 to 20% of take-home pay or refinancing fails, sell the car promptly and downsize to a reliable used car you can ideally buy with cash. Third, if selling is not an option, direct every spare dollar to principal reduction. Automate extra payments, and ensure they are applied to principal only. Finally, commit to driving the car for 10 to 15 years after payoff so you can benefit from years without a car payment. Next, let's test your understanding with a quick quiz. Quiz time. The question is, on a $33,000 car at 14% APR for 72 months, approximately how much interest will you pay over the life of the loan? Option A, about $7,000. Option B, about $17,000. Option C, about $27,000. Option D, about $50,000. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is about $17,000. That pushes the total cost to about $50,000 when you combine principal and interest. This is precisely why the APR matters so much. Now let's compare lender options so you can push that number down. Credit unions typically offer lower APRs and fewer unnecessary add-on fees because they are member-focused. They provide transparent pre-approvals and usually make it straightforward to apply extra payments to principal. Dealer financing often relies on low payment pitches, extends terms, and may include marked up rates or add-on products. The result is a higher total cost and less clarity. Next, let's ground your decision with a simple payment-to-income rule of thumb. Use the 10 to 20% take-home pay guideline to stay safe. If your payment exceeds these ranges, you should strongly consider refinancing, selling, or aggressively paying down principal. Now let's visualize how each payment is split between interest and principal, and why extra principal payments are so powerful. At the start of an amortizing loan, a larger share of your monthly payment goes to interest. As you reduce principal, the interest charged each month shrinks because it is calculated on the remaining balance. Extra principal payments go entirely to principal, and therefore accelerate the reduction of interest in future months. A simple way to estimate monthly interest is to multiply the annual percentage rate divided by 12 times the current principal. Next, let's do one more quick quiz to reinforce the best next action if you cannot sell the car. The question is, if selling is not an option, which action reduces total interest the fastest? Option A, extend the loan term to lower the payment. Option B, make extra principal payments every month. Option C, miss a payment and catch up later. Option D, only pay the minimum to avoid penalties. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is making extra principal payments every month. This directly reduces the balance, which reduces the interest calculated in future months. Refinancing is also powerful, but extra principal is available immediately, even when a refinance is not. Now, before we close, a quick disclaimer to keep your decisions grounded. This content is for educational purposes and is not personalized financial advice. Your situation may differ. Always verify interest rates, fees, prepayment policies, and any potential credit score impacts with your lender. Consider consulting a qualified professional before making major financial decisions. Now, let's lock in the most important takeaways. Focus on APR and total cost rather than the monthly number. If your payment exceeds 10 to 20% of take-home income, consider selling or refinancing. Credit unions are frequently the best source for lower rates. Extra principal payments reduce interest quickly. Finally, hold your car long after payoff to capture years of payment-free driving. Next, a quick summary and your call to action. To summarize, know the math of your loan. A high APR over a long term can cost you tens of thousands of dollars in interest. Move quickly to refinance, sell, or pay down the principal. Keep your car payment within 10 to 20% of your take-home pay and plan to drive your car for many years after it's paid off. Finally, here's how you can support the channel and keep learning. Thanks for watching. If this video helped, please like, share, and subscribe. Comment with your experience or questions so we can continue the conversation and help more people avoid costly car loan mistakes. This flowchart elaborates the decision process. You begin by evaluating whether your payment exceeds 20% of your take-home pay. If it does, the best option is to sell the car and downsize to a reliable used vehicle. Then follow a debt-free plan. If your payment is below that threshold, the next decision is whether you can refinance to a meaningfully lower rate, for example below 8% APR. If you can, refinance and automate on-time payments. If you cannot, check whether you can add at least $200 in extra principal each month. If yes, make those extra payments to shorten the term dramatically. If no, reduce expenses or increase income, then reassess and loop back to the refinance decision. This ensures you keep moving toward the fastest viable exit from high-interest debt.